Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has just recently, last week, broken out of its downtrend line resistance here. We have potentially a momentum bullish crossover here happening on the weekly chart. So it's starting to get some investors excited. Of course, there's still lots of work to do from a technical standpoint before this really morphs into a bullish look from a trend standpoint, right? Just objectively, we have a downtrend right now on the S&P. Lots of work to do to the upside, but this could be early evidence that market behavior is shifting. As we've been discussing over the past couple of months now, we expect the inflation rate that's just been going sky high for the past couple of years here. We think the odds of inflation peaking right now and heading lower are extremely high. The widespread pessimism that we've had over the past few months that's led to the worst first half performance on the S&P 500 since the 1970s, a 24% drop. We think this widespread pessimism and historical amounts of cash on the sidelines, this is the cash balance from fund managers for July 2022, higher than at COVID levels, higher than the low of 2016. And the lows of the 2008 financial crisis. When all this pessimism starts to turn around, it's going to create potentially one of the biggest rallies in history. Investor psychology can have absolutely massive impact on the stock market. And what we aim to do at Game of Trades is to profit from those cycles in investor psychology. Because one thing is sure is that they will always occur. You will always go from extreme fear to extreme greed, to extreme fear and back to extreme greed. Back in 21, right here, what did you have? You had extreme greed. Meme stocks were flying sky high. Emerging tech companies and the ARK ETF were doubling every other day. You had SPACs go absolutely out of control here. These were signs of risky behavior in the market. And now we're seeing just the opposite with widespread risk averseness. Nobody can find any reason for stocks to go higher. And that's exactly why we think there's a tremendous opportunity here. We're going to go deeper into the details of what's going on in the market, what's been going on over the past couple of weeks here. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. We make these videos multiple times a week, going through everything that's going on in the market with you guys step by step and understand how we can come out on the other side being profitable. Now, without further ado, let's get right into it. All right, so as I mentioned at the beginning of the video, we have the S&P 500 that broke out above this downtrend line resistance here, right? Now, this is really the first time where we have this type of breakout, right? You had a brief one right here, although it was much smaller, that led to a nice, powerful March rally. And here we have a second one potentially representing a change in character on the S&P 500. But there is still lots of work to do, right? If we take a look at the moving averages, we have the 100-day moving average and the 150-day moving average that are both above the price, although you could argue they're potentially curling back up here in a similar way perhaps to how these moving averages were curling back up here back in 2020 here. But this really doesn't predict anything. It just tells us we're still in a longer term downtrend. If we add the 50-day moving average here, we did see price move above the 50-day moving average for the first time since March. So, this doesn't predict anything, but the longer you have price move higher, the more you're going to see these moving averages start to curl back up and potentially suggest that we are gaining momentum once again and getting back into a bullish trend. That's not the case for now, so let's remain objective, but let's see how that looks like in a typical correction like 2018 here. Let's go back to visualize how that looked. You had all moving averages move down very aggressively here in December 2018. And then if we look forward from these levels, you can see as price moves higher and stays high, you have these moving averages curl back up. And then once price really starts to show strength, you get these moving averages curling back up. And that's really what a lot of investors use as confirmation, right? A lot of investors want to stay in the market while it's trending up to avoid risk. And as soon as you start to see breakdowns, they exit their long positions, they hedge their risk and wait for the uptrend to start again. That's not our strategy, because if we did that, we wouldn't be able to take advantage of these types of big price drops, right? The S&P 500 back here in December 2018 was at a 20% discount, which gave you just a massive, massive risk reward. If you wait for these moving averages to curl back up again, you're probably going to be late to the party and you'll have missed out on some of the greatest buying opportunities. Now, a couple of weeks ago, I believe, right here this week, I believe it was in this area right here, we had the CPI print at 9.1%. Massive surprise to the upside. 9.1%, extremely hot inflation in the US. Almost as hot as that like button after you smashed it. In all seriousness, don't forget to click on that like button. It really does help push our videos out to as many people as possible, pushes out our research, pushes out our content, and hopefully helps more people have access to educational content on the market. And look at what happened since that CPI print. We've had the market absolutely skyrocket. Now, a lot of people are saying this is just a relief rally and that the market is going to snap back to reality as soon as the trend shifts, which is possible, right? Remember, the trend is still to the downside. So the market right now, as of now, is making lower highs, lower lows. So it's extremely difficult to time that type of trend. It's the same thing as trying to pick a top while the market is trending higher. Right, it can last months of higher highs, higher lows, but the bearish case right here in November was very much there. Inflation was already skyrocketing, the Fed was getting aggressive, and market valuations were extremely elevated. Here we have lower stock market valuations, inflation is peaking, and we expect the Fed to step off the brakes in the next couple of months. So just like there was a bearish case building here, there's a bullish case building here. But seeing the market actually rally off a 9.1% inflation reading could suggest that maybe the market is front-running peak inflation. And we've discussed this before, but look at this chart. This is a very interesting chart that is hopefully going to make you understand what I'm saying here. This is what happens to bonds and stocks around inflation peaks. And this takes into account 16 episodes of inflation in the past from 1965 to 2021. And you can see here, stocks tend to bottom a couple of months before the inflation peak. The 10-year yield tends to top 3 months before the inflation peak, and the 2-year just a couple of months before the inflation peak. So the bond market yields anticipate peak inflation, and stocks also anticipate peak inflation. So using that logic, maybe the fact that the market is shrugging off this inflation peak is suggesting that market participants are already looking forward to the peak inflation that's going to come after. And if we take a look at bond yields, you can see the same thing happened here. So that's fascinating. We had the CPI print here, I believe, on the 11th of July. And that move was immediately faded and it actually broke down. Potentially this head and shoulder pattern that we have here that could actually make yields move down very aggressively in the next few weeks, which would fit with the fact that the 10-year yield peaks before inflation. Now, one of the reasons we think that this is happening is because of oil. Look at the price of crude oil on year-on-year change, or year-on-year percentage change. Since 2000, it's been almost a mirror image of the CPI. They move down and up together because as crude oil rises very quickly, it has a big impact on CPI. And you can see that upwards pressure that we've seen throughout 2021 and 2022 is now fading. We're seeing crude oil, the year-on-year change actually start to move down at $96 a barrel. And I like this chart because this projection here gives you an idea of what this chart looks like if oil stays at $96. You can see that would put tremendous pressure on CPI, downwards pressure on CPI. If oil's price doesn't continue to rise throughout the next few months, we'll be at the same spot we were at a year ago. If oil's price doesn't continue to rise, inflation will mechanically come down by itself. The only thing that won't be moving down this year is the price of our membership at Game of Trades, where we post all of our research, all of our convictions on the market, the calls we make on different asset classes, the price targets that we give, the support level that we're watching for specific entries. all of that funneled into trading ideas, investment ideas, soon a model portfolio that's going to be tracking all of our investments so that we can build a track record for the calls that we make now that we've significantly stepped up the quality of the research that we make. I think a lot of these trades that we've been talking about for the past couple of months here are going to be playing out in a big way. We already have the consumer discretionary sector that's been one of the big sectors that we've been looking at since the 14th of June. We saw a nice breakout here on consumer discretionary against the S&P 500. So an 8% outperformance of the consumer discretionary sector against the S&P 500. That's a non-negligible outperformance on this sector and definitely does look good from a technical standpoint here. Now I wanted to show you one more chart here. It's the small trader put call premium. It's currently here at levels not seen since the 2008 financial crisis. Now, by the way, this is not the actual indicator. It's a 10-day moving average of this put call premium. So when we take a look at the put call, it gives us a measure of sentiment. It gives us a measure of how complacent or how greedy market participants are. Back in 2021 here, the put call ratio was extremely low. Very, very low, lots of complacency, no risk averseness. That was the time to be skeptical of the market, skeptical of how quickly it was rising. Now look at what's happening. We have the put call ratio at levels that we typically see at bear market bottoms, right? 2009, 2002 here. Once in a decade buying opportunities. Now, I'm not saying that's exactly where we are here, but this is the type of environment that can lead to monstrous rallies. These are the moments where we want to go on aggressive buying sprees. You have to do your own research before making investment decisions. I'm just showing you what our strategy is. We like to have a contrarian standpoint because that's what can give us an edge to yield superior market returns. Buying in these opportunities where you have panic in the market, it's very difficult to do because there's so much bad news and the chart looks really ugly. Of course, that is just our opinion. What do you think? Make sure to drop a comment down below. We really appreciate all the feedback, all the comments that you guys give. It is really, really appreciated. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.